Introduction to Assets, Liabilities, and Trading Products. Understanding the basics of financial instruments. Presentation overview. Assets. Assets are anything that have value, including property, stocks, and cash. They are an important part of any financial portfolio and can be used to generate returns and manage risk. Liabilities. Liabilities are debts or obligations that must be paid. They include loans, mortgages, and other financial obligations. Understanding your liabilities is important for managing your finances and avoiding financial hardship. Trading products. Trading products are financial instruments used to manage risk and generate returns. They include stocks, bonds, options, and futures. Understanding these products is important for building a successful investment portfolio. Assets, tangible assets. Tangible assets are physical assets that have a measurable value, such as property, inventory, and equipment. They are used in finance for collateral, and their value decreases over time due to depreciation. Intangible assets. Intangible assets are non physical assets that have a measurable value, such as patents, trademarks, and copyrights. They can be used in finance for collateral, and their value may increase over time. Asset valuation. Asset valuation refers to the process of determining the value of an asset. This can be done through various methods, including market value, book value, and discounted cash flow analysis. Tangible assets, property, plant, and equipment. Property, plant, and equipment are tangible assets that have a long life and are used in production of goods and services. They are valued based on their cost and depreciation over time. Inventory. Inventory is a tangible asset that represents goods that are available for sale or in the process of production. It is valued based on its cost and market value. Intangible assets. Intangible assets are difficult to value because they do not have a physical presence. Valuation methods for these assets include cost, market, and income approaches. Liabilities. Types of liabilities. Liabilities can be classified into short term and long term liabilities and can include loans, bonds, and other types of debt. Valuation of liabilities. The valuation of liabilities is an important aspect of financial analysis. Liabilities are valued based on their face value, interest rates, and duration. Use of liabilities in finance. Liability is an important source of financing for businesses and individuals. They can be used to finance operations, investment, and other activities. Short-term liabilities. Definition of short-term liabilities. Short-term liabilities are obligations that must be paid within a year or less, including accounts payable and short-term loans. They are a crucial part of a company's financial statements and are closely monitored by investors and creditors. Valuation of short-term liabilities. Short-term liabilities are valued based on their face value, which is the amount owed to the creditor. They're recorded on the company's balance sheets and are used to calculate its current ratio and working capital. Long-term liabilities. Definition. Long-term liabilities are obligations that must be paid over a period of more than 1 year. They include bonds, mortgages, and other types of debt. Valuation. Long-term liabilities can be valued using various methods, such as present value calculations, and are important parts of a company's overall financial health. Trading products, stocks. Stocks are trading products that represent ownership in a company. They are bought and sold on stock exchanges, and their value is determined by the performance of the company and market trends. Bonds. Bonds are trading products that represent a loan to a company or government. They are bought and sold in the bond market, and their value is determined by interest rates and credit ratings. Options. Options are trading products that give the buyer the right, but not the obligation to buy or sell an underlying asset at a set price. Their value is determined by the price of the underlying assets and market volatility. Stocks. Stocks are classified into common and preferred stocks, which have different ownership and dividend rights. The valuation of stocks is based on the company's financial performance and market demand. Bonds, types of bonds. Bonds come in various types, including government, municipal, and corporate bonds. Each type has a unique set of characteristics and risks. Valuing bonds. Bonds are valued based on their maturity, coupon rates, and credit rating. Valuation can help determine the bond's yield and its attractiveness to investors. Uses of bonds. Bonds have various uses in finance, including raising capital, financing projects, and managing risk. They can also be used to diversify investment portfolios. Conclusion. Assets, liabilities, and trading products are fundamental concepts in finance. Understanding them is essential for anyone who wants to invest, manage their finances, or work in the financial sector. Thank you.